Okay, let's just jump right in. Right this second, as you're listening to this, there's a 3-digit number being calculated for you. It's this number that's quietly working in the background of your life, and it's influencing some of your biggest decisions without you even realizing it. So I've got a question for you. Is an invisible number running your life? Because, whether we like it or not, it probably is. And if you've ever looked at that 3-digit number and had absolutely no idea if it was good, bad, or a total catastrophe, you're definitely not alone. So let's start right there. Let's talk about why this invisible number is so unbelievably important, especially right now. And just to put this in perspective, get this. Over 40% of Gen Z adults have what the industry calls a thin credit file. That means they either have no score at all or one that's so new they're basically invisible to the whole financial system. So if this feels like your story, just know millions of people are in the exact same boat. So why should you care? Why the urgency? Well, because this isn't some abstract problem for someday when I buy a house. Nope. This number impacts whether you get approved for the next apartment you want to rent. It's the thing that decides your interest rate on a car loan, which can literally cost you thousands of extra dollars. And yet, some employers are even running credit checks now as part of the hiring process. All right, so we get it. The stakes are high. Now let's actually pull back the curtain and figure out what this number really is. Let's demystify it. Put really simply, your credit score is just a number between 300 and 850. It's like a grade that tells lenders how likely you are to pay them back. Think of it this way, right? If your friend asks to borrow 20 bucks, you automatically think, have they paid me back before? A credit score is just that same gut check, but on a massive scale for things like mortgages and car loans. And these scores are all grouped into different levels. Anything under 580 is, well, it's considered poor, and you're probably going to face rejections or just awful interest rates. A lot of young adults land in this fair range. Now, it's not a total disaster, but it's like leaving money on the table every single month. Our goal, is to get you solidly into that good territory and then keep climbing. So the big question, how is this number even calculated? It's not magic, and it's definitely not random. It all comes down to 5 specific factors. And once you understand these, you've got the keys to the kingdom. Okay, take a look at this. 2 things, just 2, make up a whopping 65% of your entire score. That's your payment history and your credit utilization. Yeah, the other things matter, but these 2 are the absolute heavy hitters. So let's break them down one by one. First up, the big one at 35%, payment history. This is as simple as it sounds. Do you pay your bills on time? But what's crazy is that just one payment that's more than 30 days late can stay in your report for 7 years. Not 7 weeks, not 7 months, 7 years. This is why setting up auto pay, even just for the minimum payment on your cards, isn't just a smart idea, it's absolutely essential. All right, next up at 30% is something called credit utilization. And this is the one that really surprises people. It's just the percentage of your available credit that you're actually using. So say you have a credit card with a $1,000 limit and your balance is 900 books. Well, your utilization is 90%, and that's really hurting your score even if you pay on time every month. The golden rule here is to try and keep this number below 30%. Coming in at 15% is the age of your credit accounts. Lenders, they love to see a long, stable history. It shows you're reliable. And this is precisely why that old piece of advice to close your oldest credit card is usually a really bad idea. I know it seems tidy, but it can actually shorten your average account age and make your score dip. Then we've got credit mix, which is about 10%. This just means lenders like to see that you can handle a few different kinds of debt, say a credit card and maybe a car loan. But seriously, don't go take out a loan just to check this box. It's one of the least important factors, and it's something that will just happen naturally over time. And finally, also at 10%, his new credit. Every time you apply for a new loan or a new card, it creates what's called a hard inquiry on your report. This can drop your score by a few points temporarily. It's not a huge deal in the long run, but applying for 5 different credit cards in 1 month, that can look a little desperate to lenders and it will definitely hurt your score. Okay, so that's the theory. That's how the game is played. Now let's talk about the fun part, the practical, real-world strategies you can actually use to boost that score. Let's go back to that utilization thing for a second, because there's a great hack here. So remember that card with a $1,000 limit and an $800 balance? Your utilization is a sky-high 80%. But what if you call your credit card company and ask for a limit increase, and they approve you for $3,000? Now that same $800 balance is only 27% utilization. You didn't make more money, you didn't spend less, you just changed the denominator. And your score could seriously jump in just 1 month. So, what if you're one of those invisible people with no credit history at all? Where do you even begin? Well, the path is actually super simple. First, you get what's called a secured credit card. You put down a small deposit, and that becomes your credit limit. Then, you just use it for one tiny bill you're already paying anyway, like Spotify or Netflix. And then you pay it off in full every single month. You do that, and within about 6 months, you are on the board. You're building a real credit history. Okay, I want to zoom out for a second here because this isn't really about memorizing percentages or trying to game some system. It's about a bigger shift in how we think about this stuff. And here's the thing I really want you to take away from all this. A good credit score is not the goal. A good score gives you options. It's the difference between a 6% interest rate on a car loan and a 14% rate. It's being able to get the apartment you actually want, not just the one that will approve you. It's financial flexibility. In the end, it's power. We've covered a lot of ground, so I want to leave you with just one single, totally non-scary thing you can do this week to get started on this journey. This is it. This is your homework. Go to annualcreditreport.com. This is the only official federally authorized website where you can get your full credit reports for free from all three bureaus. You don't need to sign up for some paid service. Just go there, get your report, see your number, and make sure there aren't any mistakes. That's step one, just knowing where you stand. And that's pretty much the whole story. You know, this system wasn't really designed with us in mind, but the good news is now you know the rules of the game. So I'll leave you with this to think about. Now that you know how it all works, what are you going to do with more options? So let's bring it all together. Your credit score is built on 5 factors, but payment history and credit utilization alone make up 65% of your number. Master those two, and you're already ahead of most people. Whether you're starting from zero with a secured card or pushing from fair to excellent, the path is the same. Small, consistent habits over time. If this video helped you understand your score better, hit the like button. It genuinely helps this channel reach more people who need this information. And if you want practical, no-fluff personal finance advice every week, subscribe so you never miss an upload. In next video, we're covering budgeting, specifically the 50-30-20 rule and whether it actually works in today's economy. You won't want to miss it.